Okay, good morning and welcome back, everyone, to our weekly macro outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we kick off this week here with a bit of a reversal from last week. Last week, we started off with a much more pessimistic tone with the Moody's downgrade of US Treasuries. We saw the auction in the middle of the week that drove a fair amount of weakness here in the middle of last week. And then, sort of by the end of the week, sentiment had already slowly started to, I would say, turn things around a little bit. And over the weekend, I would say trade war slash tariff driven news, especially with the EU and US kind of fast tracking their talks and trying to come to an agreement, seems like markets are taking that positively and rallying as a result of that going into today's open, which is a shortened week after Memorial Day. So we look at the S&P 500 and, with the recent with the recent pullback here, we've pulled back here to the more all-important 5,800 level here, which is a level that has provided support and resistance multiple times here for throughout all of 2025. So far, markets have bounced higher from here, which really opens us up to start, looking at all-time highs, which is around the 6150 level here, and seeing how markets can potentially retest those all-time highs on the back of kind of the sentiment that we're seeing here with equity markets here today. This is really the first time in quite some time where we're really talking about those all-time highs again. The Qs pulled back here to the 500 level here. We haven't quite gotten there just yet, but psychologically an important level on the Qs, looking for that continuation towards 540, which is, again, the all-time highs for the NASDAQ 100. You have the Russell 2000 that's still sitting below this major resistance level here. So any gains here would really start retesting 210, and we really would like to see a breakout about 210 to take a more bullish tone here on small caps, and then equal weight S&P 500 index pulling back to some important levels around 172 and looking for that bounce here today at the open. So overall sentiment over the last week has been somewhat poor, but looks like we're starting off this week on a much more positive tone. We've seen growth outperform value, by a pretty significant margin here since the beginning of April. Commodities have continued to moderate here as gold and oil largely have continued to consolidate here. One area of the market that I do think is starting to be more of a concern is the bond markets. But so far, if we look at high yield corporate bonds, we continue to see high yield at the moment, not particularly pricing in bigger concerns from a credit risk perspective. But as you can see, it's trading just around what is an important pivot area that if we were to close below, that could potentially start generating some more risk off overall sentiment. But at the moment, this particular ETF remains fairly resilient. And what we're seeing here from a yield perspective continues to be somewhat supportive here for both treasuries and corporates. We have seen VIX spike up last week intraday into that 25% level here, close last Friday around 22. There's definitely some concern that a 22 handle on the VIX doesn't truly reflect what could potentially be in terms of downside for equities. But at the moment, this sort of temporary spike provides an opportunity for option sellers to collect a little bit more premium from strategies such as cover calls, cash secured puts, credit spreads, those types of strategies. And but in my opinion, I think that the 22% handle on the on the VIX potentially underprices some of the downside risks that have started to play out here, especially in the treasury markets here over the last few weeks. Um, you see the 10-year yield did close around below 4.5% here last week. That is quite interesting considering how negative we started off the week here last week with regards to rates. So to see it holding steady around 4.45 is generally a good sign here for stability. So this is something that we'll continue to monitor and see how yields change over time. That can kind of give us a better sense for what the bond market is thinking and how it's or what it's concerned about. You have CLT, which has formed this double bottom here around 84. This is a potential area of a bounce opportunity here for TLT. If we break below 84, that would be particularly bearish here for bonds. And this is one that we are paying very close attention to, because if that were to happen, that would drive sentiment or change sentiment by quite a margin here. And then lastly, the dollar continues to decline here after kind of reaching that 50-day moving average as that resistance level. And gold, and both gold and oil, just continue to moderate around this 3150, 3500 level here, and oil around the $61, $62 level here. And within sector rotation, we see a fair amount of we've seen a lack of rotation here. The same sectors that have seen rotation here over the last few weeks have continued to see strength here, with predominantly around technology. Discretionary have continued to outperform here over the last few weeks, as well as communications. Those are the three sectors that continue to see some flows. And at the same time, we've started to see some outflows of stocks, sectors like consumer staples. You've seen healthcare underperform by a pretty significant margin here, and materials as well. So we're seeing that across the board here, with the exception of industrials actually being one of the strong outperformers here from a sector perspective. Okay, so let's take a look at kind of where all the companies stand here for the week. Give me 1 second. So so that's where we're looking at from a sector rotation perspective. We have both home builders and semiconductors. Also to look at, home builders actually been one of the sectors that continues to underperform the S&P 500 by a very wide margin here since the beginning of 2025. And even though housing starts and inventories have started to improve, we continue to see this sector continue to lag alongside with real estate. And semiconductors largely been one of the biggest underperformers of the S&P 500 over the last year. We've started to see a little bit of outperformance here in just the last call it month or month and a half. And then when we switch over to taking a look at some of the ideas here for the week, some of the ideas that I want to first take a look at here. If you look at Bath and Body Works, If you look at Bath and Body Works, this is a stock that has underperformed the S&P 500 by a pretty significant margin here. Tried to rally here towards the end of last year and the beginning of this year, and has really kind of corrected here itself. But if you look at kind of this particular stock, it's starting to show some signs of outperformance here over the last couple of weeks, some weakness here over the last couple of weeks. And this is really an opportunity that we start to see here of a stock that is starting to make some series of higher highs and higher lows. If you look at Bath and Body Works, what's interesting about this particular stock is really just the fundamentals. It's currently trading at around 8.5 times forward earnings, which is substantially lower than the industry average, around 18.5 times forward earnings, even though it is expected to grow just as fast as the companies within the sector, or rather the industry, actually expecting EPS growth that's slightly faster than the industry. Higher net margins of around 11% versus 6.5% for the industry. So you have what is arguably superior growth metrics, superior profitability metrics. This does report earnings in a couple of days here as well. That is trading at a significant discount relative to the industry. And that's really where the weakness that we've started to see here from this stock here over the last few days, I think presents a nice opportunity going into earnings that reports, like I said, on Thursday morning. And then taking a look at some other ideas here for the week. Adobe remains a stock that we continue to like here in this particular space. Adobe, as you can see, recently broke out here above that $400 level, came back to retest this level of support, and has the opportunity to start rallying from here. Looking at Adobe, this is a stock that also trades at a pretty significant discount relative to its peers. They're only trading at 20 times forward earnings versus 27 for the industry. And if you look at kind of expected EPS growth and revenue growth, it very much is aligned with the industry. But where Adobe is well ahead of the industry are its net margins. It's got 30% net margins versus 10% for the industry. So the fact that it trades at such a heavy discount relative to the industry, given the substantially more efficient company, meaning its ability to generate profits, that's really where I think Adobe is head and shoulders above its peers and has the opportunity for substantial upside from where it's currently trading right now. Some other ones that we continue to look at here, if you look at United Rental, we've seen industrials continue to outperform. One of the sectors that continues to outperform here, United Rentals, breaking out from the 680 level, coming back to retest this level of support, provides that opportunity for further upside here. If you look at United Rental, it trades at 16 times forward earnings versus 18 for the industry. So it is closer to the industry average, especially when you look at the fact that EPS and revenue growth are basically aligned with the industry, meaning it's expected to grow basically in line with the rest of the industry. But more importantly, United Rentals net margins exceed 16%, where the industry is currently around 10%. So the fact that it's more efficient, it's more profitable, and it's expected to grow as fast as the industry, yet it trades at a discount to the industry, that's really where I think the upside opportunity comes from a fundamental perspective that aligns with this technical breakout that we've recently seen on what is continuing improving strength here on United Rentals. Another one I want to take a look at here is Micron. Micron, as you can see, has kind of been in this downtrend here, but recently has kind of come back to life a little bit here above this $85 level. We've gotten a bit of a pullback here last week, and that presents another opportunity to look for further exposure or upside exposure here in Micron. And Micron like some of the other names, trades at a very substantial discount relative to its peers. It's trading at only 8.5 times forward earnings versus the industry is around 22 times forward earnings. It's expected to grow both top and bottom line faster than the industry, substantially faster than the industry. Revenue growth expected is around 22% revenue growth versus the industry is around 10%. And then more importantly, net margins for Micron is approaching 15%, where the average for the industry is around 10%. So the fact that it trades such a heavy discount to its peers, the fact that it's more profitable than its peers, is really what presents such substantial upside opportunity for a stock like Micron. And then one last bullish idea that we currently have here in the market here is Zoom. Now, Zoom has had a really nice run here recently. It's pulled back here to the $78 level. This is really where it looks attractive here for another run towards that $90 room here to the upside. Now, Zoom also from a valuation perspective looks incredibly attractive. It's trading at only 14 times forward earnings versus the industry is around closer to 27 times. Now, as part of that lower valuation is because of the fact that analysts do not expect Zoom to grow very much over the next few years in terms of top and bottom line. That does contribute to a lower than average valuation. But when you factor into the fact that it's more profitable than its peers, it doesn't quite justify such a low valuation that it's currently trading at. I do think the stock, may trade at a slightly lower valuation than the industry, but it doesn't deserve to trade at around 65% below the industry's average valuation. But there is one risk that I do see here with Zoom that I think investors should be familiar with if you're investing in this particular stock, and that's just in the because Google recently announced that they were going to launch, call it a Zoom equivalent feature built into Google Workspace or Google Workspace. And that has kind of taken a bit of a hit here for the stock price last week. So I don't particularly think that product out of the gate is particularly competitive to Zoom just yet. But down the line, that certainly is a risk here for investors in terms of Zoom. So yeah, just be aware of that if you are taking a bullish position here in Zoom. And then switching over to the bearish side, because I do think, we are in the market right now where there is substantial downside risk. It wouldn't be fair to not consider that. And there are a lot of names right now that I think provide potentially some downside exposure here. If you look at International Paper, a company that most of us don't really think too much about, but if you look at kind of the stock price, it's continued to make a series of lower highs and lower lows. It has underperformed the S&P 500 by a pretty wide margin here recently. It really kind of broke down here from a relative performance perspective and looks like it's going to continue that relative underperformance. And then if you look at kind of the fundamentals here, International Paper trades at around 22 times forward earnings, which I think is incredibly high for a company of this particular type of industry, especially when you look at their net margins are just under 2%. So razor thin margins for paper companies like this. Now, International Paper happens to be a company that is expected to grow a pretty healthy pace faster than the industry. And that is part of what justifies a more premium valuation. But with such razor thin margins and margins that are actually below the industry, that's really where I think there are some downside risks. And I think clearly the stock price is reflecting those downside risks over the last few months, not recovering with the rest of the market, really not able to bounce much alongside with the rest of the market. And I think there's some further downside risks here for international paper. Um, Apple it remains on our bearish list here, and obviously last week's news with regards to potentially tariffs on Apple has been quite detrimental here for the stock price here as well. We've got that triple top coming in around that 213, 215 level here. I think this is likely going to retest kind of 52-week lows here on Apple, and Apple like I've said multiple times before on this weekly session, Apple's fundamentals continue to be of concern. It trades at 27 times forward earnings, which is pretty substantially, which is quite a bit higher than the industry average, which is around 18 times forward earnings. Now, it's hefty margins is what's carried its valuation for so long. And so far, Apple has largely been able to defend those margins, but this is really increasingly coming under pressure, especially if there were to be tariffs announced on iPhones because of where they are made. That's going to be a huge issue for Apple investors. But even outside of that, the overall company, Apple has really kind of botched their rollout here of Apple Intelligence, or their version of AI, where it is no longer expected to even be included not only in last year's phone, which they were meant to have a software update for AI by now, but at the moment they're not even expected to have that complete by the time that the iPhone 17 is out. And not to mention, within the augmented reality space, this is really where they've staked their future of their entire company on that specific technology. The Vision Pro has really failed to capture, consumers and investors. Developers are not particularly developing for that platform at the moment, and Meta and Snapchat have continued to eat their lunch in that particular space. And there are more and more entrants into the AR space on a fairly regular basis that has started running some circles around Apple. So the fact that their core product is suffering quite a bit, their future outlook is looking much cloudier. It makes the valuation that it's trading at much harder to justify, especially in an environment that's looking more and more challenging for Apple going forward. So that's why Apple has remained on my bearish list for quite some time here, since the beginning of this year. Another company to take a look at here is Abelmar. For obvious reasons in terms of the stock price, as you can see, has continued to underperform by a pretty significant margin here. This particular stock has been trading like Apple at a pretty substantial premium relative to the industry. One of probably the most craziest valuations that I've seen, it's trading at around 330 times forward earnings. Obviously, it's because this company is struggling quite a bit here, where it's why it's trading at such crazy valuations. The net margins are negative 22%. This company continues to lose money hand over fist. Growth expectations are either zero or negative, and things just don't look positive here for this particular stock. And it's one of the stocks that is currently on our bearish list. Another one that we are looking at here is Zillow Group. Showing you kind of how home builders have struggled here as an industry. Zillow as a real estate technology company so far, has also suffered here a little bit here as well. You notice the $70 level that has provided prior support and resistance is now kind of our resistance level here and provides some further downside exposure here. Zillow trades at 40 times forward earnings where the industry is currently close to around 17, 18. It is expected to grow a little bit faster than the industry and that it can justify a higher valuation. But when net margins are negative, so for every dollar they earn in revenue, they actually lose about 3.5 cents in net income. That is what is hard to justify with valuation. The superior growth is nice, but the superior growth expectations is nice, but when you're losing money every single quarter, that's a tough pill to swallow when you're trading at such high valuations in this kind of market where, again, the real estate industry and housing overall continues to look fairly uncertain. Um, um, let's see. T-Mobile, another one that we currently have a bearish view on here right now is T-Mobile. T-Mobile, as you can see, has been one of the best performing communication stocks this year, but has recently started to take a hit here in terms of the stock prices. You can see it has continued to kind of start to rotate lower here. You see this kind of you see this rotation out of this particular stock, and now it's kind of underperforming as opposed to an outperforming stock. T-Mobile trades at 22 times forward earnings, whereas the industry median is around 10 times forward earnings. So you're talking about a valuation that's more than double the average telecommunications stock. Yet, if you look at kind of growth expectations and net margins, they really are just a little bit higher than the industry, right? So you can say that it justifies a higher than average valuation, but if growth expectations are marginally higher and net margins are just a tad higher than the industry, does that justify a valuation that's more than 100% higher than the current industry median? And I think that is also, again, a tough pill to swallow. And that's part of why the stock has recently started to underperform, is because these valuations are much harder to support in an environment that looks more and more uncertain in terms of the future. And then the last idea that I'll leave you with is Penn Entertainment, which is a stock that has recently also underperformed here and alongside with the market has failed to rally here. And so the recent underperformance, speaks to some further potential downsides. Now, Penn is trading roughly in line with the industry at around 19 times forward earnings, where the industry is around 17. But if you look at growth expectations, it comes in well below what the companies in, where its peers are expected to come in. And then more importantly, net margins are still negative. So we're talking about net margins of negative 1% versus around 10% here for the industry. So Penn Gaming struggled here recently and looks like it's going to continue to struggle going forward. With that covers what I wanted to share with you here today. I hope that this gives you a better understanding of where we currently stand here for our macro outlook session and some of the ideas that we have here for the week. Thank you so much, and I'll see you guys here next week.